Good morning, everyone. You are watching a daily market outlook for Friday, 4th of November 2011, prepared by Windsor Brokers. A lot of activities in the markets yesterday and today, especially yesterday's big story with the Greece and a lot of contradicting news coming kept the markets in the bumpy way. As we were following the news yesterday, we know that initial shocking idea of Greek Prime Minister Papandreou to call for referendum to decide whether the Greek people would vote for the austerity plan or not, finally turned into the story that will be voting for Greece to stay in European Union, monetary union also, or to leave it. A lot of anger was triggered by this decision, especially from the European officials, and some urgent meetings were made just ahead of G20 meeting and during the G20 meeting. And finally, the Greek Prime Minister basically changed his mind, and the latest news say that there will be no referendum, and Greece will proceed with the path arranged before to receive the next tranche of, I think, 103 billion euros. And according to the previously agreed plans. The Papandreou, Prime Minister of Greece, is actually facing his to be or not to be today confidence vote, as his plan of referendum failed. But even if his socialist government survives the late evening, today's late evening parliamentary vote, Papandreou's days as a Prime Minister look numbered amid the opposition calls for his resignation and the deal with his cabinet, under which government sources said he agreed to quit after negotiating the coalition with conservative rivals. There was a lot of contradictions yesterday on this subject, as direct conflict came between the Prime Minister and the Finance Minister Venizelos, who at one point said that he was even not aware of calling referendum, but at the later stage he supported the Papandreou and his idea for referendum. However, yesterday he announced that he changed his mind, and he was against the latest idea of having a referendum. Also significant that came from some media was news that the Greek cabinet in late hours of Wednesday dismissed all the military top of the Greek army for a still unknown reason. So it's quite unstable situation these days in Greece. Also today is the second day of the G20 group meeting in Cannes in France, and the group is considering injecting billions of dollars into the world economy, mainly through the International Monetary Fund, in order to increase global liquidity. The idea has been discussed to replicate of 2009 decision by G20 leaders that agreed at that time the special allocation of $250 billion of IMF special drawing rights and the IMF internal unit account to its 187 member countries. The G20 European sources also said that French President Nicolas Sarkozy was pushing to include a reference to the SDR allocation in a final G20 communique on Friday. Some members could choose to sell part or all of their new SDR allocations to other members in exchange for hard currency, for example, to meet the balance of payments needs, while other members could buy more SDRs as a means of relocating their reserves. Also, G20 sources said that Eurozone countries currently worried about the sovereign debt crisis were talking about possibility of pooling their SDR allocations in some way. One source also from the emerging market countries said that if Eurozone countries combined their SDR allocations, it could make available roughly $200 billion to Europe. The IMF, they created that SDR in 1969 as a way to support its member currencies, and they are allocated according to members' IMF quotas, which are broadly based on a country relative size in the world economy and which determines its voting power. Also today, the most significant release is the UF non-farm payrolls due at 13:30 GMT, 12:30 GMT, and the forecast for today is slightly worse than the previous month release. Expectations are for growth of build of new jobs at by 97,000 compared to 103,000 the previous month release. Anything below this would be very disappointing at this point. However, as mentioned yesterday, and also on the Fed's announcement after the rate decision that U.S. economy is not growing according to the desired pace, and as a result of this, the U.S. employment growth today will be likely showing a weakening in October, and also to pull down the nation's jobless rate, though it might have been strong enough to suggest some economic momentum is building. The non-farm payrolls rose 103,000 in September. While that would appear to suggest hiring was slowing, September's count was lifted by a return of 45,000 Verizon striking Verizon communication workers. The labor market will release, as I mentioned, this closely watched employment report for October at 12:30 GMT. The economic indicators ranging from first-time fillings for unemployment benefits to planned hirings by private firms have all pointed to an improvement in the jobs market last month. Still, the labor market remains the Achilles heel of the economic recovery of the United States, and progress is putting 14 million unemployed Americans back to work remains painfully slow for now. It's also a challenge for President Barack Obama, who faces a tough fight for the re-election next year. Those signs of modest improvement could buy the Federal Reserve extra time before loosening the monetary policy further to aid growth. From today's calendar, as mentioned, unemployment, non-farm payrolls, and unemployment rate that is expected to stay unchanged at 9.1%, and average hourly earnings monthly are expected to stay also unchanged at 0.2% compared to the previous release. Earlier, just to mention, from Eurozone, we have German factory orders due at 11 o'clock GMT. Slight improvement from last month's negative release of -1.4 is seen today. Expected the orders to increase by 0.1% in month of October. Now let's take a look on the markets and see the latest movements of the major currencies and the commodities. The euro maintains a sort of positive tone as shown on the hourly chart. Studies are still in a way positive, and the pair is currently moving around the upper boundary of the recent yesterday's range after bumpy trading yesterday based on conflicting news coming from mainly Greece, and then very surprise action of the central bank or European Central Bank to lower the rates by 0.25%, as this was not expected at all, as the first rate decision of the new president Mario Draghi. Most of the analysts were expecting a new president to stay pat at the first rate announcement. However, he surprised everyone with his action to lower the rates. As if you remember on the previous sessions, I mentioned that recent action of European Central Bank during this year was a bit too fast when they moved the rates higher in 2 times by 0.25% to 1.5%. It was, I would say, a bit too fast according to the current situations, and most likely they were not assuming that the current crisis would go deeper and having more impact. Now it seems that they are correcting these, let's call them mistakes, and bringing rates to the levels that would be more acceptable at the current situation in the world economies. Also, the inflation forecast for 2012 remains bleak for Eurozone, and most likely will hold above projected 2%. Now back to the euro. The hourly studies, as I said, are slightly positive. However, the pair is from last night during the Asian session in very quiet trading, as most of the markets are awaiting today's non-farm payrolls release, and this might give some more light and create some new action in the market. The near-term tone from 136.07, the 1st of November low, is still in play, as the pair is correcting the recent down move from 142.46 down to 136.07 with 38.2 Fibonacci retracement at 138.50, where is also the previous high posted yesterday, currently capping the upside. 20 days moving average on hourly chart still holds the downside, and the break above 138.50 is expected to resume higher and open next levels at 139.25, which is Fibonacci 50%, and then 139.74 low of 31st of October, and 61.8% at 140 zone, which would be actually break and signal possible reversal higher towards 142.46 previous high. On the daily chart, we see that the pair is still in the downtrend. However, the studies are showing some positive action at this point. Clearance of 138.50, which is also 55 days moving average on the daily chart, is to give some boost and resume higher. The downside for now remains supported at 136.55, 136.07, and holding above here would keep in play the recent bullish tone from of the broader picture from 131.45. However, on the upside we have 90 and 200 days moving average currently at 141.04, and in neutral mode trading. So break here is also a significant point to open the test, wait for test of 142.46. The British pound is holding a near-term positive tone despite breaking 159, 158.90 strong support, and pressing posting the marginally fresh low at 158.75 yesterday, with the subsequent bounce higher, breaking above actually the recent bear channel and the main bear trend line drawn from 161.64 high of 31st of October. Also clearance, brief break actually above 160.46 previous high, has so far reached 160.60. Current easing is finding good support at 160 level, with the 20 days moving average on 4-hour chart at 159.75 underpinning. The near-term structure would weaken in case of loss of 159.50, which is the higher low of yesterday, and that would signal also return back to the bear channel and possibly focus again 159 and 158.75 in order to resume the short-term downtrend from 161.64. On the upside there, that is capped for now by 20 days moving average at 161.40, where the two false breaks occurred and the subsequent pullback further weakened the tone, keeps the upside still limited, with only break here to signal bottoming at 152.71, low of 6th of October, and then focus higher for possible retest of 166.17 high on the short term period. Loss of 159, 158.75 is too weak in tone. As we can see, the 55 days moving average is still holding to the downside, and the positive signal is 20 days simple moving average breaking above. That gives the positive signal for the pair, and holding above 90 days moving average, currently standing at 160.15, is to focus upside levels at 161.40 and 161.64. Meantime, we need to see break of, as I mentioned, 160.60, and then we have 160.92 high of 1st of November, above which to turn focus higher to 161.64. Dollar yen holds its extremely narrow range between the extreme points at 77.75 and on the upside the current range is just slightly above 78. Nothing much to say than a break of either side of extreme point 77.75 and 78.40 on the upside to define the new trend. Above 78.40 opens 79 and then 79.52 the post intervention high, above which is to focus our targets at 80 and 80.23 spike high of 4th of August. On the upside also we have 200 days moving average currently at 79.82, so it's capping this point, but positive development on the daily chart might signal some fresh strength of the pair, as Bank of Japan, as mentioned in previous sessions, stays all the cards are on the table and the possible intervention is not ruled out in order to further support. However, the pair has stabilized at these levels now. It's for the Bank of Japan was important to move it away from the risky levels and the fresh record lows, and stabilizing at this point. In some time future we might see some further reaction of the Bank of Japan if they decide to further support to further weaken the local currency. The dollar Swiss is on the back foot from the recent high of 89.56 posted 3 days ago on 1st of November, as the succession of lower highs keeps the focus to the downside. However, the support was found at 87.60, 50% Fibonacci retracement of the latest up leg from 85.66 to 86.89.57, with fresh strength coming out this morning, and looking for attack at initial barrier at 88.69, which is the near-term bear trend line, and then the lower high at 88.92, above which to signal an end of the current corrective pullback and refocus 89.56 high. On the wider picture, we see that the pair is still in the corrective mode. However, current break of 4 hours 20 days moving average brings some more positive tone, as the pair is regaining momentum on the 4-hour chart, The likely scenario would be attack at 88.69. We need to see break here and break above 89 in order to signal a resumption of the positive tone from 85.66. On the daily outlook, also the 200 days simple moving average currently at 87.06 holds the downside and underpins current rally from 85.66. As the 55 days moving average now forming a golden cross crossing above 200 days one, that might give additional boost to the pair. From the commodities, gold remains bid after initial consolidative range trading that found support. Actually lost the initial support at 1700 and 1695, dipping down to 1681, with the fresh strength emerging from there. Clearance of the upper boundary of this range at 1752 has so far seen 1767 high posted yesterday. As the daily studies are regaining momentum and entering in the positive territory, immediate upside barrier is at 1770, which is 61.8% Fibonacci retracement, above which to open levels at 1790, 1800 and 1826 next. The uncertainty in the current situation in the world with all problems from Greece, Europe, are keeping the gold again, bringing gold back again in focus as the safe haven instrument, and most of investors are moving. This was a result actually of past couple of days situation with the Greece and the G20 meeting, when investors simply feel most safe if turning into gold. So the positive tone for gold on the short term is still in play, and we are looking for levels at 1790, 1800 and 1825 on the upside. Current correction is seen on the overbought conditions and should hold above 1735, which is 20 days moving average, and then 1720 in order to maintain the recent leg higher from 1681. Crude oil is still in the consolidative mode after hitting 94.58 high on 25th of October. That was retested yesterday. The downside remains well supported at levels of 90 and a brief break below at 89.16. However, the current situation on the short term shows some positive tone and possible push higher through this recent range ceiling in order to open way for test of the key barrier that is currently capping the upside, which is 95 level, 50% Fibonacci retracement, and 200 days simple moving average, break of which is required to resume the recent short-term uptrend from 74.94 low of 4th of October, and expose levels at $100 per barrel, and recent high posted on July at 100.60. Failure to clear 95 barrier would signal further range congestion below this level. However, loss of 90 and 89 levels would be risky to further weaken the tone and possibly signal of posting a lower top of the broader downtrend and expose some levels on the downside. However, the current short-term situation looks quite supportive for crude oil based on technicals, as we can see also on the daily chart that the instrument remains supportive. However, clearance of 95 is required to resume.